Meta Materials, Inc. is one of the most dramatic stock market sagas of recent years. It evolved from a visionary high-tech promise into a meme stock frenzy and finally into complete liquidation. While there are striking parallels to AMC and GameStop, this story has a much darker ending for shareholders. A nanotech dream from Canada. Meta Materials traces its roots back to a company founded in Canada in 2007. They specialized in so-called metamaterials, artificially engineered structures designed to manipulate light, heat, electricity, or radio waves in novel ways. The vision was ambitious: transparent displays, superior antennas, next-generation solar films, and anti-counterfeiting security features. It was a classic deep tech narrative that fit perfectly into an era of technological euphoria. Throughout the 2010s, Meta acquired several smaller firms and technologies, creating the image of a rapidly growing innovation cluster. However, this also drastically increased both complexity and the need for capital. The great leap to the stock market. Instead of a traditional IPO, Meta chose to go public via a reverse merger with Torchlight Energy. Torchlight was a struggling U.S. oil and gas company that effectively served only as a shell for the listing. Just before the merger, Torchlight mobilized capital one last time, driven by a sudden explosion of retail demand and social media hype, before merging with Meta, allowing the combined company to appear on the NASDAQ. This structure was both brilliant and dangerous. It gave Meta instant access to the stock market and fresh cash, but it also immediately exposed the company to the brutal volatility of the meme and penny stock world. Hype, MMTLP, and entering the meme zone. Surrounding the restructuring of Torchlight, the infamous ticker symbol MMTLP emerged. This was a special preferred share construct linked to the liquidation of old Torchlight assets. MTLP became a highly speculative plaything for retail investors, fueled by wild price fantasies. This led to legal battles over trading halts and alleged market manipulation, resulting in ongoing lawsuits where investors are demanding thousands of dollars per share. With this, Meta Materials had firmly arrived in the meme zone. Reddit threads, YouTube channels, and Discord groups built a narrative of a suppressed technology gem and a heavily shorted company of the future, very similar to the stories surrounding AMC and GameStop. Business reality: cash burn instead of quantum leaps. On the operational side, the breakthrough never came. Products remained largely in the research or early pilot stages. Revenue was low, losses were high, and the cash burn was significant. By 2023, the company was forced to implement a realignment and consolidation plan, which involved restructuring, focusing on a few core products, and massive cost-cutting to save $20 to $30 million annually. Despite these measures, the financial situation continued to deteriorate. The stock slipped deeper into penny stock territory, even as the narratives in online forums became increasingly bullish, a classic disconnect between the story and the balance sheet. The crash, Chapter 7, and total loss. The breaking point came in August 2024. Meta Materials filed for Chapter 7 bankruptcy in the United States. This is a liquidation process where operations are completely shut down and assets are sold off to pay creditors. The entire workforce, including the CEO, was let go. The website was turned over to the bankruptcy trustee and now serves only to provide information about the liquidation. For shareholders, this practically means a total loss. Later, the trustee extended deadlines for filing claims, partly due to ongoing litigation regarding alleged market manipulation and MMTLP. However, this does not change the fundamental situation. Equity holders stand at the very bottom of the chain. AMC and GameStop, parallels in the meme vortex. AMC and GameStop served as the blueprint for what Meta experienced on a smaller scale. Both were driven into extreme short squeezes in early 2021 by coordinated buying from retail investors, causing heavily shorted stocks to explode in value. With GameStop, the massive short positioning of hedge funds combined with social media mobilization triggered a historic squeeze that serves as a textbook example of meme stocks to this day. AMC also experienced several squeeze waves, with the stock jumping from just over $2 to over $70, even though its cinema business was heavily battered by the pandemic. In all three cases, AMC, GameStop, and Meta, an us against Wall Street narrative emerged. It was no longer just about financial metrics, but about symbolic battles, hodl culture, and hunting down short sellers. The decisive differences. Despite all the parallels, there are hard differences. AMC and GameStop generate real revenue and were able to use the price hype to strengthen their balance sheets and reduce debt through capital raises. Meta Materials, on the other hand, possessed mostly futuristic technology without established cash flow, faced high development risks, and had less room to convert hype into sustainable financing. While AMC and GameStop still trade today and continue to exist as operating companies, albeit with high volatility, Meta Materials is effectively history after its Chapter 7 filing. What remains are bankruptcy proceedings and the legal battles surrounding MMTLP. Why the story is so gripping? The history of Meta Materials is fascinating because it combines several layers: high-tech visions, aggressive capital market deals, meme stock narratives, community hope, and finally, legal wreckage. In contrast, AMC and GameStop show that the same meme mechanism can either save a company or merely keep it on life support for a while, depending on whether there is a viable business model and good timing by management behind it.